So, I've just had this email from Wealthify, a leading Robo advisor who manages investments on behalf of their customers. They're saying, because of world events, that they've made some changes to the portfolios of all their users by selling some UK and European holdings.
Wealthify and platforms like them are paid handsomely in platform fees to navigate their clients' money through the confusion and the turmoil of the market. Their clients don't need to know anything about investing and still will be given a diversified and hopefully high-performing portfolio.
So surely they know what they're doing when they pull money out of UK stocks and plough it into US bonds instead. We'll be looking into the wisdom of this in this video, as well as the action or inaction we'll be taking off the back of this move by Wealthify in our wider portfolios, and whether we all should be dropping our portfolio allocation to UK and European stocks.
Plus, we'll compare the past performance of wealth managers like Wealthify versus a suitable benchmark, Vanguard's FTSE All-World ETF, to judge whether they know what they're talking about. And look into whether there really is an advantage to tweaking your portfolio based on the news cycle. Or is trying to second guess the market, such as by reducing exposure to certain regions of the world, a step too far for index investors and more akin to stock trading? Let's check it out.
If you want to invest with Wealthify, have a £25 cashback bonus on them when you open an account via the offer link on moneyunshackled.com, linked to in the description below.
What Wealthify announced and how we might take advantage. According to the wealth manager, they've reduced the level of exposure to European and UK shares held in their plans and have redirected the proceeds into longer dated US government bonds. We've long argued against investing a huge allocation to the UK just because you happen to live there, but this concern about UK home bias is not the reason for the sell-off.
In fact, they have a strong UK bias across their portfolios, with their highest risk level portfolio, Adventurous, allocating 26% of client money towards UK stocks and bonds. Their other portfolios go much further, with their middle risk plan, Confident, allocating 38% to the UK. But these allocations have just been reduced from even higher unspecified weightings. They've also reduced their exposure to European stocks.
Fund managers and robo-advisors employ big teams of experts to try and second-guess the market, lock in profits where profits are made, and cut losses where investments are underperforming. As individual investors, we might try to take advantage of this, either by investing our portfolios with a managed robo-advisor service, like those offered by Wealthify, Nutmeg and InvestEngine, or else be influenced by the actions they take and adjust our self-managed portfolios accordingly.
Why are they ditching the UK and Europe? The wealth experts at Wealthify have looked around at the market and seen that the FTSE 100 is up year to date, driven by rising oil prices and the UK stock market's reliance on the energy sector. They're also saying that on other global indexes, including the US's S&P 500, stock market losses have lessened over the last couple of weeks after the initial shock of the invasion of Ukraine, with most indices now above the levels they were at before the start of the war.
They're taking advantage of what they perceive as a turning point in the market to, in their words, lock in profits and reduce risk. They're making the following assumptions: that stock markets are not properly factoring in risks posed by rising oil prices, that Europe is likely to be one of the most affected regions by the war given its proximity to Ukraine and dependency on Russian energy, and could fall into a recession this year.
That the UK has performed well this year, but is unlikely to keep this up. By selling UK positions, they're aiming to lock in some gains. And because of rising inflation, rising interest rates, and war, stocks are riskier now as an asset class. In response, they've filled the gap left by UK and European stocks with US bonds.
Are they right? On the face of it, everything they're saying seems reasonable, but at the end of the day, their decision to sell off UK and European stocks is based on a forecast, or in other words, a guess about what is going to happen in the markets this year. Should they really be selling off UK stocks when the FTSE 100 is finally going through a period of outperformance versus the American S&P 500?
What if the same logic had been applied to the S&P 500 back in Q3 2020, selling out of US stocks when the American index was outperforming UK indexes? You'd have missed the explosive US bull market of 2021, which has now placed US stocks at a far loftier valuation than what they were at pre-COVID, versus the UK's FTSE 100, which has now about broken even. While it's tempting to sell at a high, what you often end up doing is selling good stocks that are capable of climbing even further, and buying cheaper but lower performing assets with the proceeds.
While it seems sensible to cut ties with the investments most likely to be affected by the Russian war, such as European companies, what you might be doing here is selling European stocks when the price is low in an attempt to avoid it going down further as the war drags on. But you'd be pretty annoyed if European stocks rebounded just as you'd sold them, perhaps if some sort of resolution to the war was reached.
Since we won't know for sure whether Wealthify are right to sell off UK and European stocks until we look back with hindsight, months or years into the future, we must instead look at their past performance to get a feel for whether these investment managers have a knack for getting it right.
Performance of Robo managers versus Vanguard's VWRL. If we look at the performance of a couple of the biggest robo-advisors, Wealthify and Nutmeg, versus a suitable benchmark, we should get an idea of whether their investment management teams are worth paying for. We've chosen to compare the performance of their highest risk offerings to VWRL, an all-world, low-fee exchange-traded fund offered by Vanguard, which we consider to be the default fund for any investor with a high risk tolerance who wanted to invest in the whole world for minimum effort.
While Wealthify includes small allocations to bonds, cash and property, even at the highest risk level, it's as close as we can get on the platform to an all-equity position. Nutmeg are 100% equity at the highest risk level. We could only get benchmark data for total returns on VWRL in British pounds going back 4 years, and the robo platforms themselves have not been around for very long anyway. But what we can see for the available comparison years is that VWRL beat the robo managers each and every time.
A contributing factor for this may be the higher platform fees charged by Wealthify, 0.6% and Nutmeg 0.75%, which are included in the performance figures. There are also fees for the funds they invest in, though these are similar on average to the 0.22% fund fee charged by VWRL. This table is a fair comparison if we assume you hold VWRL on a platform like Trading 212 or InvestEngine's DIY area, who charge no platform fees to hold ETFs.
If you wanted a managed portfolio but without the big fees, you could use newcomer InvestEngine's managed service, which costs only 0.25%.
Another reason for the underperformance in this short period of time could be the inbuilt UK bias of the robo-advisors, and we know that apart from year-to-date 2022, the UK has done poorly in recent years. Or maybe it's that trying to second-guess the market doesn't work, and VWRL did better because the US holdings within it were allowed to grow without any fiddling.
Should you tweak your portfolio with the news cycle? Our limited data from the last 4 years suggests not, but this is by no means conclusive. Stock market performance is best measured over decades and centuries than years. According to J.L. Collins, author of The Simple Path to Wealth, most retail investors lose money when investing in the stock market because they buy high and sell low, panicked by the slightest market movements.
He also says that even people who invest in funds make worse returns than the funds themselves report each year because people do not own those funds for the full year. They flit in and out of them trying to take advantage of events like Brexit, COVID or a war, and almost always get the timings wrong. But what about the experts? The people employed to outsmart the market by companies like Nutmeg and Wealthify, or by managed funds like Scottish Mortgage or Fundsmith Equity.
If we look at the history of managed funds in general, they have been consistently beaten by low-fee index funds. In 2013, Vanguard did some research into this. Again from J.L. Collins. Starting in 1998, Vanguard looked into all of the 1,540 actively managed equity funds based in the US that existed at the time. Over the next 15 years, only 55% of these funds had survived, and only 18% had managed to both survive and outperform their benchmark index.
That means 82% failed to outperform their indexes, and nearly half actually died in the attempt, but they all charged top dollar to try. We ourselves reported on some updated analysis into this trend for the period between 2006 and 2020 from a study by S&P Global.
It concluded that during this time frame, only 25% of managed funds were able to beat their indexes over any 5-year period, while top performance was short-lived. Just 39% of top performers stayed in the top half of league tables after 5 years, with 20% being relegated to the bottom half and 13% gone altogether. The remaining 28% had changed their asset allocation out of all recognition from their initial strategy.
Why fund managers feel obliged to tweak. Announcing changes to a managed portfolio is common on the Robo platforms. It's part of their service to let you know that some thought is being put into the management of your money. All managed funds and wealth managers feel obliged to actively fiddle with the portfolios under their management because being able to tell their loyal customers about the wonderful decisive steps they've taken sounds far more impressive than sending out an email 4 times a year saying no changes made.
In fact, because investors are all watching the news and taking in the horrors of COVID, war, inflation and so on, they expect the custodians of their wealth to be doing something about it, even if doing nothing at all would be better all round. In their email, Wealthify says it's worth taking a long-term view and having a diversified portfolio to help ride out the bumps in your investment journey. Ultimately, growth over the longer term is the norm, but it's never a straight line.
We agree, but using the same logic, we would refrain from touching our portfolios at all and take the long-term view that our diversified portfolios would carry us through the bumps in the road without the need for fiddling. This is called a set and forget strategy, and because we set our portfolio allocations to survive the next several decades, we will not be tweaking our positions in UK and European stocks. But we do acknowledge the great service the robo-advisors provide to people without the confidence or know-how to manage their own portfolios. Let them build you a portfolio and you'll be doing better than most people in our view.
If you want to know the precise allocation of the funds we invest in, then watch this video next, which discusses the ultimate portfolio and where you can invest in it with 0 platform fees. Wealthify concludes with the telling phrase, "It's our job to watch the markets." By definition, as a wealth manager, they're right. But would the markets be better left unwatched?
Question of the day, will you be selling out of your UK and European positions, or will you be taking a longer term view? Join the conversation in the comments below. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.